Well, another RBA meeting and another cut and paste job. Hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 18th of June 2024, and before I get started, you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for yourself. So we had the RBA meeting today, and to no one's surprise, they kept interest rates unchanged. And the other thing they didn't change was the accompanying statement, particularly the last paragraph, which seemed to be cut and paste from the previous meeting. There was really no change in any of the statement at all, and it really gave the market no clues as to how the RBA's thinking has evolved on interest rates and inflation. The RBA is in a bit of an interesting position. Australian data continues to be fairly inflationary, or at least more inflationary than data in Europe, more inflationary than data in the US. So we're starting to see central banks in the Western world start to cut interest rates or look at cutting interest rates. We've seen the European Central Bank cut rates, the Canadian Central Bank cut rates, and many are expecting that the US Federal Reserve will cut rates in September. However, like I said, Australian inflation data and other economic data has been rather sticky, and most are not expecting the RBA to look to cut rates until next year at some point. Obviously, things can change if the data does weaken, but at the moment, it doesn't seem like the next move, will be lower given how Australian data has come out. So today, I think a lot of people were looking towards the RBA for guidance as to whether they did see, that we were at peak rates, whether they saw a rate cut this year, and they provided none of that. They really gave no additional information than they did, several months ago. Like I said, it's been a cut and paste job at each of the last several meetings, and there was no market response whatsoever to this meeting. There were maybe a couple of points to the downside immediately after, but otherwise it may not have even occurred for all the market cared. Now, I do think the RBA should be a bit more aggressive is not the right word, but a bit more explanatory in their statement and really sort of tell people what they're thinking rather than just sort of these blanket statements that they can repeat month on month on. And so I think it was a little bit of poor form. No doubt we'll see some speeches from central bank board members over the coming months, and that'll have a bit more information, give us a bit more of a clue as to what they're thinking. But I do think that they're missing an opportunity here with outlining their path for policy. And keep in mind that monetary policy, by and large, in fact, almost entirely, is their ability to signal to the market, their ability to talk to the market, and their ability to influence the market. And I don't think there've been any real influence, at least not in these statements, for several months. The other thing I wanted to touch on was iron ore. Iron ore's come off a fair bit over the past month now. It's been falling for about almost 4 weeks straight, 3 weeks and a bit. And it did dip further last week. It has ticked up a little bit over the past couple of sessions, but overall it's come off quite a lot, and that has dragged the Australian iron ore miners lower. It's dragged, BHP, Fortescue, Rio, each down by, in some cases more than 10%, up to 20%, in some cases even further. In fact, we actually saw Fortescue fall about 5% on open this morning, and that was after news that a large institutional investor had sold out of a very large proportion of Fortescue shares, around 1.5% of the outstanding shares of the company. They did that as a block trade, they did it at a huge discount to market prices, and they did it before open today. And that obviously hit Fortescue's share price today. They closed, I believe, over 5% lower, and again, it doesn't really sort of promote optimism in the sector. Cyclically, this is a bit of a weak period for iron ore prices, and so no surprise that we've seen prices come off. We're also seeing the Chinese economy perform particularly poorly, especially in the property sector and the steel demanding sectors, and all of that's not great news for the iron ore miners. We are starting to approach the August reporting and dividend season. And usually around sort of July, start of July, you start to see some buying in the iron ore miners as you get people buying them up to hopefully achieve those strong dividends and also to get those franking credits due to the 45-day at-risk holding rule. We haven't really seen signs of any buying coming in just yet. In fact, we'll look at the charts later and we'll see that there's been a pretty strong downwards movement pretty continuously for the past sort of 3 weeks. While the iron ore miners have been weak, global markets continue to be strong, including our own market. So to pick up the slack, we've had to see just about every other part of our market appreciate or rise in price. None more so than the banks. The banks are the biggest part of our market, and if the iron ore miners are falling and our market is rising, that means the banks are going to have to pick up the slack, and they've obviously jumped quite strongly. So we had a fresh all-time high on Commonwealth Bank today, whose price is starting to get pretty ludicrous, I would say. Finally, I just wanted to touch on money printing. It was a big topic of discussion over the last sort of decade or so, and everyone sort of pointed towards the US Federal Reserve with their quantitative easing programs as being, the world's money printer. The reality is, though, that the Fed wasn't actually printing any money. They weren't creating any new money, essentially. That money was already out there in the form of longer dated government bonds, and what they were doing by quantitative easing was essentially converting it into shorter dated government bonds or cash, essentially. And so, the money was already out there in the form of government bonds. They were just converting the maturity to a shorter date. What is money printing is borrowing. So when someone borrows, essentially because of fractional reserve banking, they are creating new money, credit creation. We are seeing a strong period of money printing at the moment, perhaps even the strongest period of money printing ever, with the US federal government having a huge government deficit at the moment. By some measures, they're actually increasing their deficit by about $1 trillion every 100 days. That might sound like a lot of money, and it is. It certainly is an extremely large amount of money. And when the US government borrows that amount of money, they are creating that amount of money out of thin air, essentially. So we are actually seeing one of the strongest periods of money printing in human history. It's because of huge US government spending relative to their receipts, and to finance that deficit, they're borrowing, which is essentially money printing. This is one of the reasons I believe for the extreme stock market strength around the world this year. It's one of the reasons why risk assets have appreciated so strongly, and probably one of the reasons why inflation has been so sticky. Usually, this sort of borrowing would be curtailed by high interest rates, high costs of borrowing money. That doesn't seem to have been the case this time around. At least the US government or US politicians don't seem too concerned about the costs that they're borrowing at. And why would they? The market's convinced that the borrowing costs will go down soon. So I just wanted to say, we are seeing the money printing that QE supposedly was occurring now, and that's perhaps one of the reasons for the extreme strength we've seen around the world. So let's have a look at the charts for this week, guys. And I did quickly want to touch on the iron ore miners here. I've chosen Rio because it's got probably the clearest downwards move, and we can see that it's really come off a lot over the past sort of 3 or 4 weeks. In fact, if we use the measurement tool here, over the past sort of 17 trading days, it's down more than 10%. Technical correction, it's down around 13%, and that's of just 3 weeks of trading essentially. So that's happened in the face of iron ore prices falling, other commodity prices falling, and that's been a bit of a drag on our market. The only reason that our market's been able to hold up while this has been occurring is due to the strength of the banks and a few other stocks, but particularly the banks. So this is a chart of CBA. This is Commonwealth Bank. And we can see that it jumped to a fresh all-time high today, huge rise of 2% on the close, and that extreme move has allowed our market to hold near its all-time highs, while the miners have been coming off. So CBA, previous all-time high was around 122, it jumped from there to 126, it's jumped further today to 128. This is the most expensive bank in the developed world, probably the most expensive bank in the world, depending on how you measure it. And it is a bit extreme in its valuation. Doesn't mean it's going to fall anytime soon, next week, next month. But I will say that at some point we will see probably a severe downwards revision in the share price here. It's very, very hard to justify these prices from a sort of valuation basis. And while valuations don't seem to matter too much in the short term, they do tend to matter in the longer run. So let's have a look at the XJO, the top 200 stocks on the Australian market, and we can see that it's still in this broad sideways range. To the downside, we've got support at 75.50 and 7600, and to the upside, resistance at 78.50 and 7900. With the strength that we've seen today, and that's largely been driven by the fresh all-time highs in the US, it looks likely that we'll head back towards 78.50. If that breaks the all-time high at 7,900. Overall, like I said, it's the US market that's been driving everyone higher, and they saw fresh highs overnight themselves. They jumped to about 54.50 on the S&P 500, maybe just above it, and we've never seen these levels before. We don't know where this move will stall. It will stall eventually, but at the moment it looks like it's just going to keep going. We've seen successive continued all-time highs this year, and the momentum, while it has slowed at points, is definitely still pointing to the upside. Markets tend to like round numbers. Maybe 5,500 will be a sticking point, maybe it won't. If we do see a pullback, the previous all-time high resistance at 53.75 is the first level to watch, and then we've got the longer-term uptrend line if that breaks. So I will wrap it up there for this week, guys. Let me know in the comment section below if you think markets are going to go much further. Hopefully you guys enjoyed. If you did, click like, click subscribe, and we'll see you in the next one.